December kicked off with another bold statement from the incoming US president. This time, Donald Trump targeted with the BRICS nations, threatening them with a dramatic 100% increase in trade tariffs. The soon-to-be resident of the White House demanded that the bloc's countries commit not to introduce their own currency to replace the US dollar. No doubt, nobody expects such guarantees. However, Trump's statement marked yet another driver in the looming trade war and sent investors flocking to the US dollar. As a reminder, BRICS currently consists of 9 member nations: Brazil, Russia, India, China, South Africa, Iran, the United Arab Emirates, Egypt, and Ethiopia. At the recent summit held this October in Kazan, no country discussions about the creating an unified currency were reported. On the contrary, it became evident that the bloc is still far from establishing a common currency for mutual settlements. However, this did not stop Donald Trump from later claiming that his threats were the primary reason for delaying the process. The introduction of a 100% tariff is likely to be viewed as a warning for now. Nevertheless, in the recent weeks and in years on this topic has triggered an immediate rise in the US dollar. After losing more than 1.5% in the previous week, the $6 currency index opened December with the recovery trading in a positive territory above 106 points. Apart from Donald Trump, other factors could significantly impact the volatility of currencies and other assets. For a start, investors are speculating on further rate cuts in the United States and the Eurozone. If the Federal Reserve decides to cut rates in December and outlines a dovish outlook for early 2025, it could pave the way for the Santa Claus rally, a term used to describe the traditional stock market growth in December. However, if the Federal Reserve decides to pause on rate cuts, the US dollar could continue its upward trajectory, potentially dampening the Santa Claus rally. The dollar would also maintain pressure on its trading partners, especially the euro. And this is particularly relevant as the European Central Bank is expected to lower interest rates this month. Market forecasts suggest a nearly 30% chance that the Eurozone's rate could be cut by 50 basis points on December 12. Moreover, while Donald Trump consistently generates ideas that bolster the dollar, Europe continues to demonstrate a readiness to slide into another political crisis. And this time, the spotlight is on France, where the far-right National Rally Party is threatening a vote of no confidence in the government. To avoid a crisis, the French government may have to make further budget concessions. Otherwise, downward pressure on the euro could quickly intensify. Notably, today, 10-year government bonds from France and Greece reached parity, considering that Greece is often labeled by the media as the sickest member of the European Union. This parity level causes alarm. On a Monday, amidst political uncertainty in France, the euro logged its largest single-day decline in months. At one point, it even broke through the critical round support level of 1.0500. However, it eventually rebounded within the daily range of 1.0501 to 1.0591. On a Friday, the euro reached 1.0597, its highest level since November 20. And we see how quickly domestic political issues can wind down the euro's value. After last week's rise, the euro-dollar pair remains within a short-term uptrend. After testing the technical level at 1.0496, analysts expect a climb toward the resistance level of 1.0546 and further to 1.0597. For a bearish reversal and a trend change, The peers need to push the price into the key technical support zone of 1.0459 to 1.0445 and close below it on the daily time frame. For the bulls, it makes sense to consider long positions during corrections from the September low of 1.1000 for the medium term. In the oil market, the incoming years has set the stage for a rise. After a sharp decline last week, Brent crude gained nearly 0.8% during the first half of a Monday session. Firstly, the oil market received support from a positive economic data out of China, published over the weekend. And the manufacturing PMI rose to 50.3 points in November, and this marked a 7 month high and served as a positive factor for the oil prices, as China remains the world's largest oil importer. Additionally, market attention is focused on the upcoming OPEC Plus meeting, rescheduled from December 1st to December 5th. Bloomberg previously reported that key cartel members were discussing further delays in the plans to increase oil production. The odds are that OPEC and its allies may postpone these plans by several months. As a result, Brent crude prices jumped to around $72 per barrel today and remain in an upward trend within the range of $71.70 to $72.70 per barrel. The Russian ruble is worthy of note today. After avoiding a collapse last week, its sell-offs under the budget rule were suspended. As a result, the ruble is trading steadily today. The dollar-ruble pair may trade within the range of 106 to 111 in the coming days. Meanwhile, the Russian currency is weighed down by several factors, and the main drivers include inflation risks in Russia and the new sanctions, which have complicated settlement chains for exporters. The strengthening of the US dollar, fueled by Donald Trump's latest statements, also plays a role. Speculative factors should not be overlooked either. So that's all for today. We monitor developments in the financial markets. Subscribe to our channel and follow news with us. See you soon!